This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
There are questions. People have them. They're asking them. But are they the right questions is what we're going to get to the bottom of today. What are we asking our financial and retirement planners versus what should we be asking them? So this is Jon Hicks, founder of J. Hagan Capital, here on the Retirement Solution, week in, week out usually I'm the one asking the questions and you getting the answers. Today we're going to flip it a little bit and say, okay, Mr. Advisor, let's talk about these questions from this survey, as well as the questions that you want people to be asking, whether it's an advisor at J. Hagan Capital or an advisor in any part of this great country of ours.
Let's just be real. You got lazy. Instead of coming up with your own questions, you want to use someone else's. There's nothing wrong with that.
I don't feel like working today. I don't feel like doing my job today. And so you have to do it because you've got 2 children and a wife and you're running a business and you're managing people's savings. So I'm just going to pile on and put something else on your list to do, John. And I'm not sorry.
Let's do it.
I'm not sorry. RetirementSolutionShow.com is our website and where you can go to start the conversation with John and his team at J. Hagan Capital. Now, regarding questions that you might have, there was a study done by Natixis finding the top questions people are asking their retirement planners right now. And the 4 top questions, according to this survey: 1, am I protected from a downturn? Question number 2, what do I need to do to outpace inflation? Am I going to meet my goals? Which I feel is a little bit vague. And then number 4, how do I preserve and pass on what I built? So from your perspective and talking to folks in your office, do you agree? Are these questions that you're seeing people ask most? And perhaps not more importantly, but laterally, what are questions that you want people to be asking, that people should be asking?
Sure. I mean, those 4 questions are pretty good, right? And frankly, the fact that people are asking them, I think they're pretty smart.
Okay.
The first one you mentioned, am I protected, in my portfolio? I think that's a starting point. But here's the question we all really need to be asking, whether we're doing it for ourselves or we've already hired someone. The question isn't, am I protected? It's how am I protected? In what exact
add a word. Very
ways?
important. Okay.
It's so important. Yeah.
Okay.
It seems like it's just semantics or whatever, or wordsmithing.
Yeah.
But the way that actually works, not am I protected? Because that's easiest to ensure. You've got, $30,000 in your checking account. Mm-hmm. That's obviously protected. The question is, how exactly is your portfolio protected? Because if we've worked our whole lifetime, 20, 30, 40, 50 years, some people even more, and we've socked away all this money. At that point in time, the thing of it is we've done the hard work. Hopefully the markets have helped us or the interest rates, and they've propped that market up. The question is now, what have we done to protect the money? Not is it protected? What specifically? Are we using stop losses? Are we using derivatives? Do we have options on the downside? Do we have non-correlated asset classes? What are we using to diffuse a downturn, right? And we've talked about this on the show quite a bit. The markets, they look to be pretty resilient. Having said that, we're the second most expensive we've ever been in the stock market in the United States. The only time we were more expensive to buy into the market versus today was in 1999 going into 2000, and that started the dot-com bust. Now, is that a reason to run for the hills? Is that a reason to freak out?
Because you think about all the money that we've made, the NASDAQ, all the tech stocks, and then at that time it was the dot-com. There's just a lot of similarities.
There's a lot of similarity. Yeah. So were we still more expensive then than now? We were. Okay. But this is the second most expensive. So especially when we're looking at maybe talking about retirement, either we've just retired or we want to do it in the next 3 to 5 years, is it a really big deal to know exactly how you're protected? The answer is yes. Because the only thing that can stop us, if you think about it, the only thing that can stop anyone from getting retired and staying retired is if they don't have enough income to spend when they're retired.
Got it.
Otherwise, they got to go back to work. You got to go call Walmart and see if they got a greeter job, or you got to go back to your old job, probably for not as much income, right? Because they have an upper hand. Or you have to completely change things, and you may not be getting paid based on your skill set. So the real question should not be, am I protected? How exactly are you protected? Are some of your assets insured? Are they guaranteed? Do you have a guaranteed income stream? Do you have a guaranteed pension? Your Social Security. By the way, there's no guarantee that Social Security, the way that we know it today, will even operate the exact same way over the courses of your retirement. So when I say, how are you protected? That's what we need to know, right? Because a lot of people, when they say, well, John, there's really no way to be protected unless I have a pension. Correct. So if you don't have access to a pension, the very next thing you could consider, which is a personal pension, is like an annuity. Are they great? They're a tool, just like anything else, right? So whether you own a stock or a mutual fund or a bond or an annuity or real estate or cryptocurrency or gold or silver, they're all just assets that you have to figure out which mix of those protect you the most.
Right.
So if you're thinking about protecting income, annuities are not bad at that. That doesn't mean you get one. It just means you want to know how precisely are you protected, right? So that's the big one. The next one is, how am I going to keep up with inflation? Now, guys, this is going to be a little bit of a tougher one, mainly because we're seeing inflation stay kind of elevated, coming down a little bit, but we're hearing time after time after time, the headlines are saying interest rates are going to come down, which means we're not going to be earning nearly as much money in those money market accounts and CDs and so forth. So we have to have an eye on the prize. We want to make sure that if we have $10,000 today, that it's not worth only $5,000 down the road, and we still need to live off of it. So we do need to overcome inflation. So this is where we want to consider, Heather, what are those inflation protected things that we own? Do we have TIPS, which are Treasury inflation protected securities? They're very, very liquid. They usually buy U.S. debt, but they are protected with inflation. There's also a numerous, if not unbelievable amounts of structured notes and principal protected notes. Now, these are often offered by banks, so they have some version of insurance on them. But basically, as long as that bank stays in business, they will potentially offer you much better returns than just normal CDs. Those can be attractive components. There are some annuities that offer increases in income or increases in inflation if inflation stays high. These are all things that exist. And of course, real estate historically has done quite good. Gold and silver have done quite good over time. The question is, how are you going to keep up with inflation? You can't just have all of your money in bank protected assets that are standard, because every year we have a little bit of purchasing power that we lose, right? So we have to make sure that a good portion of our portfolio in our office, 50-50 is balanced. 50% that's pretty safe, 50% that has some risk exposure you're comfortable with is a good starting point, right? The more risk averse you are, we get you a little bit more on the safe side. The more acceptable you are or risk tolerant you are, we ramp it up the other way. But we have to know how we're keeping up with inflation. But that means we have to be investing with some potential risk, right?
Got it.
Those are big ones. Now, some things that you didn't mention that I think are important. How much are we paying in fees? This is one that every single day I run into, and I am amazed, and it's no one's fault, but most people have no idea what they're actually paying in fees for their investments, for their advisor, for the combination of the both, on their insured account to their bank account.
This is something we've talked about before, because it's not hard. It's not easy. It's difficult to figure out.
Absolutely.
Because of the way that they build that fee layer.
It is hiding in plain sight. And by the way, it is out there. I will guarantee you, I can't guarantee it, but I feel, rest assured, it is in print somewhere what you're paying. But is it very difficult? And do they make it, unfortunately, very difficult to find that information? Yes, they do. So here's an easy way to understand it. If you own actual mutual funds, chances are you're paying a lot more in fees than you think. If you own mutual funds and you're working with a financial advisor, you're probably paying 2 higher levels worth of fees than you're even understanding of. Because anyone that owns mutual funds, my only real question is, why? Because exchange traded funds, which are institutional level, essentially mutual funds, which you can protect, you can put downside risk parameters on them. You can be tax efficient with them. There are very few things in an exchange traded fund that wouldn't be better than a mutual fund across the board. As a matter of fact, I can think of none. I can think of no singular reason why a mutual fund would be better than an exchange traded fund. So you're probably paying more than you need to simply if you own mutual funds. So go get a second opinion, right? Ask your guy what you're paying, but I would absolutely get a second opinion to find out what are you leaving on the table. And here's an example. We met with a lady a couple of weeks ago, and she had come in and she'd saved about $1 million. tremendous amount of money. And she was paying about $19,000 a year in expenses. Okay. Well, in the beginning, it's like, well, $19,000, that's not a small amount of money, but it's $1 million. Guys, that is 1.9% that she was paying annually for the investments plus those advisors.
That was the fees she was paying on her?
Just the fees, 2% a year. So if you looked at that, if she wasn't paying, if she was paying what she should be paying, which should be 1% or less, all in, if she just saved that difference, that could have amounted to over $388,000 in savings that she could still have in her accounts if she was paying less than 1% versus almost 2%. So it's a huge amount. But that is one that I do not hear asked enough. Hey, what am I paying and what should I be paying? Most of us, if you're getting good quality, skilled, holistic advisory advice, which means they need to be able to understand tax understandings, estate understandings, how to protect your money, how to grow your money. Typically, all of that all in and inclusive of the advisory fee should be 1% or less. If they have CPAs and attorneys on staff, that's even better, especially if they don't charge extra for that. But that is a starting point to gauge yourself. If you're paying more than 1% and they don't have CPAs and attorneys on staff, again, the question is why? Because without question, the good companies out there that are offering those services are not charging 2%. So you can save yourself a ton of money, but you have to ask the question.
Got it.
The last thing that I was actually going to mention that wasn't on that list is what happens when my plan changes? Well, ladies and gentlemen, this is probably the most important part about having a good advisor. We know your plan's going to change. They change all the time based on health surprises, based on living arrangements, based on, unfortunately, people have divorces or lose spouses, tax law changes. All of these things change all the time. So we have to be prepared and have a plan that's fluid enough to take care of that. But I do not hear people asking that enough. Hey, what happens when my plan changes? This is why at a minimum, you need to be sitting down with your advisor and going through, not your investments. That is almost irrelevant if you own good stuff. That you should be going through, hey, are you have enough income to do the things you want to do? Are you planning all those vacations? What is the cost of that? Hey, do you need a new car, hot water heater? Does the roof need to be redone? All of those things are so much more important than going through just what was on your statements that has already been presented. We want to make sure we're understanding when your plan changes, are you already prepared? Most of our clients, they are, and they may not even know it until they ask. It's like, this is why we did this. This is why we did this. This is how we're good. And that sleep at night mojo, that whole thing where you just feel good because you can sleep at night, that changes all those fears. But ask, what happens when your plan changes to your guy or in your own mind? If you don't have the answer, find a second opinion.
John and his team, they are here to be that second opinion, help you with that second opinion process. If you want to reach out to them, do so. We've got links posted in the show notes. You can also visit us anytime, retirementsolutionshow.com, asking yourself these 4 questions. Not am I protected, but how am I protected from a downturn? What can I do to beat inflation, to keep up with inflation at the very least, if not beat inflation? What fees am I paying to you, Mr. Advisor, that I've been working with for however many years? And also, what happens when my plans change? If you don't know the answers to those questions, John and his team, they are here to help you understand. It's your money. You deserve this clarity. We can't say that enough. And John and his team, of course, they're here to help. retirementsolutionshow.com, or just click on the links we got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 188279094.